Hello everyone, and welcome to Accounting Insights with Rula. Today, we're diving into some important review questions on analyzing and classifying transactions. We'll be working through key concepts like T accounts, the chart of accounts, and the trial balance. Throughout this session, you'll see how these topics typically appear in questions, and I'll share some useful tips along the way. Make sure to participate. When a question appears, pause the video, try solving it on your own, and then hit play to check your answer. Let's jump in and get started. Before we begin the review questions, let's clarify an important concept in accounting: the difference between temporary and permanent accounts. Our previous video explored how debits and credits work using the T account structure. Now let's build on that by examining how different accounts behave at the end of an accounting period. Imagine checking your bank account and finding that your balance resets to zero every month. Sounds strange, right? In accounting, not all accounts function the same way. Some accounts stay open and carry their balances forward, while others reset to zero at the end of each period. But why does this happen? Let's break it down. In accounting, different accounts respond differently to debits and credits. Assets as well as dividends and expenses increase with debits, while liabilities, capital, and revenue increase with credits. Understanding this distinction is crucial for categorizing accounts as either temporary or permanent. Permanent accounts, also known as real accounts, like assets, liabilities, and capital, are recorded on the balance sheet. Their balances carry forward to the next period, meaning the ending balance of one period becomes the beginning balance of the next. On the other hand, temporary accounts, also known as nominal accounts, include revenue, expenses, and dividends or withdrawals. Their role is to measure performance over a specific period, whether a month, a quarter, or a year. Once that period ends, their balances are transferred to a permanent account, typically capital or retained earnings. Since they serve only a temporary purpose, their balances reset to zero at the start of the next period. Now that we've reviewed this information, let's move on to the review questions and apply what we've learned. Let's examine our first scenario. Imagine you own a busy restaurant during Ramadan preparing for iftar. To ensure smooth operations, you purchase essential supplies for $700 in cash. How do you think this transaction affects the accounts? Which account increases and which one decreases? Take a moment to analyze before we discuss it. In this transaction, we debit the supplies account with $700 to reflect the increase in assets as more supplies are now available, and credit the cash account with $700 to reflect the decrease in assets, since cash was used to pay for the supplies. Now let's consider another situation. Imagine you're preparing your restaurant for Ramadan, expecting a rush of customers at iftar. To keep up with demand, you decide to upgrade your kitchen by purchasing new equipment for $2,700. Since you don't want to use all your cash at once, you pay 1/3 upfront and agree to pay the rest later. So how does this transaction affect your accounts? Here's what happens. First, we debit the equipment account for $2,700 because the business now owns new equipment, which is an asset. Next, we credit the cash account for $900 since that amount was paid immediately. And finally, we credit accounts payable for $1,800, representing the amount still owed. This way, the restaurant is ready for Ramadan while managing its cash flow efficiently. Let's move on to another situation. Imagine that after upgrading your restaurant's equipment for Ramadan, you decide to manage your finances more efficiently. Instead of keeping the full amount as an outstanding balance with your supplier, you take out a loan to settle part of what you owe. So what happens in the accounts? Since you're shifting the liability from accounts payable to notes payable, we need to make an adjustment. First, we debit accounts payable for $1,800, reducing the amount owed to suppliers. Then we credit notes payable for $1,800, recording the new liability in the form of a loan. This way, instead of owing the supplier directly, the restaurant now has a structured loan agreement. It's a smart move to manage payments while keeping cash flow in check. Let's look at another transaction in our Ramadan restaurant. Imagine that during iftar, the restaurant receives $800 in payment from customers enjoying a delicious meal. How does this affect our accounts? First, we debit the cash account by $800 to reflect the increase in assets as more cash is coming into the business. Then we credit the fees income or sales account by $800 to record the income earned from serving iftar meals. Now that we've covered the basics of structuring accounts, let's move on to a practical exercise. We have a list of accounts and our task is to rearrange them correctly as they appear in the general ledger. We'll also assign a unique two-digit to each account. Let's break it down step by step. In accounting, the general ledger is organized in a structured manner to ensure consistency and clarity. Each type of accounts is assigned a specific numerical range which make it easier to organize financial records. Assets are assigned numbers from 11 to 19, representing everything the business owns. Liabilities are numbered from 21 to 29, reflecting the amounts the business owes. Capital accounts fall within the range of 31 to 39, including the owner's investments and withdrawals. Income or revenue accounts are categorized between 41 and 49, capturing the earnings generated by the business. Expenses are listed within the range of 51 to 59, representing the costs incurred to operate the business. This structured numbering system ensures that financial transactions are recorded accurately and efficiently in the ledger. Next, let's organize the accounts into their proper categories and assign the correct numerical codes. Now you are looking at a random list of accounts. Some are assets, some are liabilities, and others relate to revenue or expenses. It may seem unorganized, right? But the beauty of the accounting lies in its structured system. When we apply the system, everything falls into place effortlessly. Let's start by discussing assets. Assets are the things a business owns and they are assigned numbers from 11 to 19. Cash is listed first, number 11, because it's the most liquid asset. Next, we have accounts receivable at 12, representing the money the business expects to receive. Following that is supplies at 13, covering materials used in operations. Equipment is assigned the number 14, representing long-term resources. Next, we move on to liabilities, which are the amounts the business owes. Liabilities are numbered within the range of 21 to 29. Accounts payable, which includes outstanding bills to suppliers, is assigned the number 21. Notes payable, which refers to the business's formal debts, is given the number 22. Now we come to owner's equity, which signifies the owner's stake in the business. Owner's equity is numbered from 31 to 39. Capital is assigned the number 31, representing the owner's investment in the company, while drawing, which tracks withdrawals made by the owner, follows at 32. Revenue accounts fall within the range of 41 to 49. Here we find fees income, which represents earnings from the business activities, assigned as 41. Finally, we have expenses numbered from 51 to 59. These expenses cover the costs necessary to run the business, such as salaries expense at 51, which tracks employees' wages, and supplies expense at 52, which records the cost of materials used in operations. With this organization, we now have a well-structured ledger where every account has a designated place. Now let's apply everything we've learned to this final question. We're given a list of accounts with their balances, but they are not in the correct order. Our goal is to arrange them properly and use that structure to prepare a trial balance. But before we reveal the solution, let's take a moment to revisit what a trial balance is. A trial balance is an essential accounting tool used to verify the accuracy of financial records by ensuring that the total debits in the ledger equal the total credits. It's prepared at the end of an accounting period as a summary of all ledger accounts, listing their balances in the debit and credit columns. Since every financial transaction follows the double entry accounting system, where each debit entry has a corresponding credit entry, the total of all debit balances must always match the total of all credit balances. This process helps accountants detect errors, confirm the integrity of financial data, and ensure that the books are balanced before preparing financial statements. To prepare a trial balance, we follow a simple process. First, we list the accounts starting with assets, then liabilities, equity, revenue, and expenses. Then we record each account's balance in the correct column. Debits on the left and credits on the right. Finally, as you can see, the total debits amount to $75,000 and the total credits amount to $75,000. Since both sides are equal, our records are balanced, meaning we can proceed confidently to the next stage of financial reporting. With this, we have reached to the end of this session. I hope the review questions on analyzing and classifying transactions have clarified and deepened your understanding. Thank you all for listening. Goodbye.